This is Advisor 3.0, a show designed to help you as a financial advisor elevate your professional practice, transform your clients' lives, and take your business to the next level. I am Abraham Okusoya. Welcome to the show. One key questions that come up in my conversations with financial planners is how they can expand their range of services to a client. And one particular area that I am beginning to learn more about is this concept of lending, and specifically Lombard lending. This might be a new area for you to think about as a financial planner, but I've got the experts on this subject. I'm talking about none other than David Newman, who is the founder and chief executive of Firenze. David, welcome to the podcast.
Thanks for having me on.
So, David, first of all, let's talk a little bit about your background as an entrepreneur. Take us back to the journey that led to where we are today.
Yeah, I'll kind of go slightly further back than kind of just the Firenze side, but it brings it together. So my background was in wealth management. I worked at Barclays as an advisor, then worked at UBS as an advisor. And whilst I was there in a private bank, I fell in love with Lombard lending.
Right.
This whole idea that you can lend against investments, and I did a lot of Lombard lending for a lot of different clients, but the place where I first fell in love with it was one of my clients used it to go buy Tesco's, literally the Tesco Express buildings.
Right.
Andy, we had looked after 32 million from at UBS, and he had a £10 million facility against the portfolio, so he could borrow money from UBS, secured against the portfolio, and he would go to an auction on a Tuesday night and he would go buy the actual building that Tesco Express was in. He'd call us up on a Wednesday morning and say, Dave, can I draw down 900 grand? I've bought a Tesco and I need to close by Friday. And I just loved this as a concept that he was paying UBS 2% a year, getting a 8-9% yield from Tesco as a guarantor, and was not disrupting his investment plan, was leveraging both sides of his balance sheet. And before I know it, he owned 8 or 9 Tesco Expresses and a Subway building, all financed off UBS's money. And it was fantastic. And that's why I fell in love with it. But I also got quite jealous and was like, why can't I borrow I've got my 60 grand portfolio at Barclays Stockbrokers. Why can't I borrow 10 grand against it and kind of use that as a way of doing interesting things? But so I always liked the idea of how could you open it up. But I did nothing with that for kind of 7-8 years whilst I was building my first business, a private equity software business called Delio. As the co-founder of, we helped Cooch, Barclays, UBS, many others on how they took private equity to their clients. But I exited that business a couple of years ago. Lasted about 5-6 months of kind of semi-retired life and enjoying hanging out with a 3-year-old daughter as much as you can. And before you know it, I kind of needed to get back and get some adult company. And so I kind of started thinking about what was next. And a lot of what I looked at was kind of democratization of financial services, opening up of financial services products. And to me, it kind of reignited my kind of love back of Lombard lending and going, well, this feels like it's the last thing that the private banks keep to themselves that should be opened up to a broader audience, that will be opened up to a broader audience and can be, and someone can build a huge business in this space. And that kind of served as the genesis of Firenze and the idea of can we do something to open up Lombard lending? And kind of that's the last 12-18 months have been building the foundations of how can we open a business that enables the non-bank wealth management market to offer Lombard lending to their clients as easy as a private bank does.
All right, incredible story. The only thing is, I don't know what Lombard lending means. So explain that to the ignorant me. What is Lombard lending?
It's a very simple concept at its core. Think of it like almost like a mortgage against your portfolio.
Right.
You've got a house, it's worth £1 million. You will borrow £500,000 against it. You've got a 50% loan to value. It's the exact same concept. You've got an asset and you've got debt secured against it. It just so happens, rather than a property, the asset is your investment portfolio. So a client might have £600,000 of investments. They might be able to get a 50% loan to value, so they can get a £300,000 loan secured against their investments. But as opposed to like a mortgage where it's typically, it's a fixed term, it's 25 years, it's all these things and it's complex to set up. The investment portfolios, they're valued daily, so you can get it set up straight away. So you typically get clients can draw down straight away. And they're typically structured like overdrafts and rather than a fixed term loan. So you borrow and draw as you see fit and repay when you need to. So they serve as a great flexible way of taking finance just secured against your investment portfolio.
That's interesting. Why? Why would I want to take a loan 50% secured against my
And
portfolio?
you can take as much or as little as you want to kind of these things. Like the typical, I think most clients that use it fall into kind of two buckets. It's either short-term liquidity or it's long-term strategic leverage. And if you look at them, they're both doing them in very different ways. But the reason in all scenarios across common both is, and I'll come on to the use case slightly, but it's in both scenarios, it's cheap, it's efficient, it's flexible. All of those things are far better than other types of credit. So because it's used against liquid secured assets, they're typically 2 to 3% over base. So lots cheaper than lots of other forms of credit. Because it's like mark to market assets, typically people can get it straight away. So if they need money fast, they can get it typically the next day, the day after. Similarly, if people want to have the flexibility to draw and repay as they see fit, they can do that. And if people want that ability to have just extra liquidity, and particularly without disrupting their investment plan. And that's amazing. So when I come to like talk about those short-term use cases, people might say, right, okay, I don't want to be in a chain on my property. I want to bridge a property transaction for 3 or 4 months. Or a common one we're seeing this month is, hey, I'm due to pay my tax bill of £1.5 million in January because I sold loads of assets before the budget. But now I don't get my bonus till February, or I get a big dividend from my company in September, and I want to go through that. And rather than disrupt my investment plan, trigger capital gains tax, be out of the market, and typically I may decide I'm not going to go back into the market anyway because I'm too scared to, markets have gone up and which I'm not done, or markets have gone down and I'm scared now. It kind of allows people the access to liquidity very quickly, very efficiently, very cheaply, without the need to disrupt investment plans and sell assets, and without triggering capital gains tax. For those that use it for the long term, it is sometimes it's just about gifting to their children. I want to create liquidity to get the common use cases we see is, hey, my son and daughter want £100,000 each to go buy a flat in Clapham. I want to help them onto the property ladder, but I don't have £200,000 spare, and I don't really want to give up full access to that. So I want to help support them with a different way of liquidity. Or for some people, it's just, hey, I've seen this opportunistic property purchase I want to go do, and I'll use my investments to go fund it. It's about people just getting into a way of leveraging both sides of their personal balance sheet.
This is interesting. So I get the case for the short-term liquidity, and maybe we'll explore that a little bit. And the long-term side of things, we'll come back to. So you're saying cost is about 2 to 3% over the base rates?
Sometimes it starts with a 1 for bigger loans, but typically most people are paying 2 to 3 over.
And is there a range in your mind of the percentage of the portfolio that you will start from or go up to?
Yeah, so the maximum we will do as a business is 50%.
50%.
So some of the private banks historically might have done 70%, and we believe like it's about being a conservative lender, being a sensible lender, and doing lending in the right way. So the max we will ever do is 50%. It's about protecting customers. But if someone's got in a liquid portfolio or assets that, I know we might only get to 30 or 40, but typically the maximum we will do is 50.
So that's what I was going to ask you. To what extent does the asset allocation play a role in that? If it's 100% liquid, 100% equity in public markets, you'll go up to 50. If it's, I don't know, a 60-40 portfolio between equity and bonds. Again, public market, you'll still do 50%.
Yeah, we'll probably still do 50. Right. So the assets we will lend against are like cash, bonds, equities, gold, funds that invest in the above. Right. We won't lend against private equity, we won't lend against hedge funds, and structured products as an example. So if people start having portfolios that are more geared towards them, that is when we start getting towards 30-40. But if people have got a diversified multi-asset class portfolio, in short, if they're well advised, we're lending 50%. We're lending 50% LTV.
Right, understood. And then let's get into the tax wrappers. To what extent does the tax wrappers matter in this equation? So I'm thinking, ISAs, GIAs, SIPs. Are these things, which of the offshore bond, onshore bond, are these things, which of this would you lend against versus not?
So we will lend against GIAs and ISAs today.
Right.
And what we'll hope to bring online over the course of the next couple of months is lending against onshore and offshore bonds.
Right.
Because they're the sensible assets to lend against.
Okay.
We will never lend to an individual secured against their pension.
Right.
I don't think it's allowable anyway, but even if it was, it's just not the right thing for borrowers. I don't think it's just with a consumer duty lens, just from a moral compass lens, a reputational risk. You don't want to be seen to be calling in your security if anything went wrong. What we may do in the future, though, is lend in a SIP. So we might lend to a SIP secured against its assets and allow them, particularly for long-term growth. But no, today, GIAs, ISAs, and offshore bonds, onshore bonds coming very soon.
Yeah, that's the SIP angle is interesting. I assume they're in the accumulation phase, let's just say below the age of 55 anyway, there's no way for you to call on the debt.
Exactly.
Right.
So the only way we can call on it is say to them, the day you're like that, it's ultimately that Daily Mail test of someone on the day, if you end up in the paper for calling in your loan, something goes wrong, you pull in the loan the day they turn 55, and you just don't want to be in that position. You don't want to run the risk of ever being in that position. So it's the wrong thing to be doing, to be lending to individuals against their pension.
So we're focusing mainly on ISAs and GIAs today, and then further down the line, you expect to bring in...
Yeah, bonds will be within the next couple of months.
Right, okay. You talked earlier on about the use cases, and one of those was this idea of, long-term gifting to family, that sort of thing.
Yeah.
I guess someone brought this to my attention in during the budget, and particularly in terms of the IHT implication. And they were suggesting to me that, well, this sort of Lombard lending could be used as a way to gift asset to family, which then falls outside of the estate and creates a debt against the estate. How is this come up in your thinking or conversations? How are you thinking about this?
Yeah, so from an IHT perspective, it's not something that we actively see, and it's not something we actively encourage. I think it's right. It's fair that you can reduce the value of your estate, and you have a debt against it. You can take yourself very easily below the IHT threshold and get the money out of it. But I think you start playing into a grey area that a client needs to be well advised and well supported the circumstances for that to be done. So I think it's never something we would promote at a product level, say that this is an IHT mitigation strategy by using it. But we have certainly had advisors that have come to us and say the reason that client are borrowing is for it. But it's so fact dependent that I would never say that it is Lombard lending should be seen as an IHT strategy. I think the budget where we saw more interest was around capital gains tax.
Right.
And I think that particularly with, and we still see it where people think Rachel Reeves hasn't stopped here and is probably going to go slower than she intended, but it's still going that direction. Is people say this kind of people they may have lots of pregnant gains in their portfolios and have a liquidity need. And yes, borrowing doesn't escape the need to pay capital gains tax anytime.
Kick the can down the road.
But it allows those assets to carry on compounding without the need to trigger the CGT at that moment in time. So capital gains tax was where we saw most of the action around the budget, and where we see most planners talking about it is with a CGT lens. But yes, we have seen people look at it from IHT because it's absolutely right that reduces the value of your estate.
Yeah, obviously we're talking about this in the context of advice, and
exactly.
we'll come back to how advisors can access these things. But when the loan is actually issued, is there a term, or is this, as you said, indefinite?
It's a running account overdraft. So we set it up as the facilitator. So let's say you could say, hey, Dave, I want to borrow £100,000 against my £500,000 portfolio. The client kind of applies for a facility. So they just have a credit limit. And then they might come to us, and they might not use that for a few weeks, and then say, oh, actually, I want to draw down £40,000, and then I want to pay 20, I want to draw. There is no time limit from when they draw down. It just works like a credit card, effectively, overdraft against the portfolio. So they could, in theory, have it forever and a day.
That's interesting. And does the size of the credit, the available credit, change against their portfolio, this 50% thing?
If there was major movement. So we try to set our levels so that the reason we're conservative 50 is that we allow for major movements. But if someone had a limit of £500,000 against a £1 million portfolio, and their portfolio was all of a sudden worth £600,000, yeah, we're not going to be given a £500,000 limit, but we're not going to change that limit just because there's a 5% market movement.
Right. Right. This is interesting because another use case that I'm thinking about is during the drawdown phase of retirement.
Yeah,
you know,
absolutely.
there is this thing in the decumulation end of retirement where we're starting to think about sequence risk
Yeah.
when markets down for and often
Absolutely.
for a short period of time. In the US, there is the research around home equity loan where you open this line of credit
Yeah.
and you draw it down for a year or two for the market to recover, so the withdrawal
Yeah.
comes out of that. Is this the use case that?
Yeah, it's certainly something we're over probably. It's not something we've looked at much, but probably in November, December, we had 4 or 5 conversations with advisors looking at it for exactly that. Of just, but not just in the decumulation phase. Actually, just generally looking at it as even liquidity management during. When one advisor was speaking to pre-Christmas was saying, "Hey, look, I always advise my clients to have 3 to 5 years of liquidity in cash."
Right.
But actually now with my clients that like it where they know they've got the ability to draw down liquidity for emergencies, I might only advise 12 months of liquidity in cash because if they need it, that emergency, they can draw down then. So absolutely using it in your context as well of accumulation as just a liquidity buffer for when it's the wrong time to draw down or sell assets, find an alternative.
That's interesting. So then the question is, let's talk about the mechanics of this. Is there technology that you've built to be able to conduct the application, assess the asset? How do you get information about the asset? Because the asset's sitting on the platform.
Absolutely. So we've built a Lombard lending platform that takes the data in from investment platforms, or when we work with, if they're a Model B directly, we take the data on the asset so that we can underwrite. So a borrower, and we might for some scenarios, we white label our Lombard lending platform. So take the example of P1 that's in the press of, they will go on to their P1 app and they will go through an application journey, and it takes 15 minutes for them to go through and onboard and ask questions about their loan purpose, their affordability, how they intend to repay it in the future, just to get an understanding, and go through ID&V and sanction, all those things. But in the background, what we're doing is we're taking the data directly from the platform so that when the client's applying, we're underwriting the assets in real time to analyze that, so that by the time they've applied, we can give them that lending decision and say, great, you told us you've got a £1.1 million portfolio. We've checked and it's actually only 900 grand. So you can't have the 550 you asked for, but you can have 450. So we can do that as they're applying through the journey. And then once they get their limit set up, they then again through the app can request their drawdowns, manage their repayments, all digitally through the Lombard lending app.
So you've got an app,
that we brand to third-party organization.
Understood.
So we brand to either the platform or the wealth manager.
Right, understood. So it's either the platform or the wealth manager, and today you've got it live on P1?
Yeah, so there's 5 wealth managers that we're now set up with, or in the process of, that we've signed and are in the process of setting up. But I think P1 might be the only one that's in the public today.
Okay, so you can't tell me the other ones. You can't tell how it is. You tell me afterwards.
I'll tell you afterwards. But there's one top 10 wealth manager. Right. There's a few DFMs that have got a couple of billion. But in total, we're now starting to approach 100 billion of AUM of wealth managers that are working with us.
That's incredible. 100 billion in Lombard lending?
No, 100 billion of their AUM.
Right, okay, understand.
No. I wish we were close to 100 billion.
Good stuff. Model B is when the firm comes to you directly for the application.
Yes. Well, we can take the data directly from them because they control the client's agreements, the client's assets. In that scenario, we just work directly with the Model B firm.
Right.
Whereas Model A, we would work with Fidelity and Aberdeen, a Timeline, new platform, a Transact. We would work directly with the platform itself to set that up.
And today, is there any of the major advisor platform that you guys are working with?
Not live yet, and not saying yet where, but watch this space over the course of the next quarter or two, and there'll be a fair few platforms. So the best thing advisors can do is go ask Aberdeen Fidelity Transact and say, if you heard of these Firenze guys, and pester them for Lombard lending, which might help move things a little bit quicker. But we're speaking to them all, and we're not far behind on a couple.
And are you guys thinking about this as a direct consumer proposition at some point?
No, I don't think it's the right space for us. It's ultimately clients should be well advised. Like Lombard lending, there are risks to the product. There is potentially complex. It's very simple at a headline level, but I think it should be used with advice, with support, through a wealth manager, and particularly someone naturally given. We need the investments anyway with them, and we don't want to be trying to sell in investments. For us, it should always be a B2B2C proposition, never a D2C.
That's interesting. Can advisors come to you directly? Because technically, the advisor can provide you the data of the assets that the client has. It will obviously be manual and all that stuff. But in practice or in theory, is this...
if the firm is big enough,
right,
to make it work, because what we need is that ultimately the things we need to have the data on at least a daily basis. We need the prevent money being able to leave the account without our approval.
Right.
We need to show that's good. So the advisor needs to be able to, that's the reason why the Model B works rather than Model A, is that we need them to be able to control the portfolio and prevent withdrawals without our approval. And thirdly, we need our letter of authority to be accepted if anything was to ever go wrong. So if the advisor firm is of a big enough scale where they can set up the POAs for us, they can put in place the right controls, and they can provide us the data automatically, then we can, in theory, work with them. But what we generally find is if an advisor practice is less than $1 billion of AUM, they don't have the scale to come to us directly, but they can really push the platforms and work with the platforms and to help leverage it through them.
Because in practice, you need to take security over that account, so to speak. Okay. Which takes all this work behind the scene. A couple of things I wanted to ask you then is, so funding sources, how are you actually getting this money that you're lending? And what is Firenze's, I said Firenze earlier, but Firenze's, is it Firenze? Firenze. Okay, you're going to have to teach me that. What is Firenze's role in this? Are you the lender? Are you the credit broker? That sort of thing. Explain the structure going in the background.
And there's a lot of work that we put into actually, a lot of the complexity in IP we put into is actually designing the end-to-end structure to make it work for everyone. But we are the lender of record. We are the lender. We are the one that underwrites the loans. We are the one that the client and the advisor, the platform, the ones that they deal with. Now, clearly, we don't have, we've got £160 million of firepower to make loans.
160 million.
Yeah, so we're very much open for business. We have a large firepower to go, but clearly we don't have that set ourselves. We're well funded from an equity side, but we're not 160 million funded.
Yeah.
So we have third-party banks we work with to provide those loans. So we effectively have a facility with the banks whereby when we make a loan, we draw down from them to provide that funding onwards. So we have one bank that we work with at the moment for the vast majority of our facilities. And over the course of this year and next, we'll be building out that to have a range of partners for different types of needs across different firms.
Okay, good stuff. So let's talk about, you've obviously been working on this last time when we actually first spoke about this was over a year ago.
Yeah, I think it was over a year, yeah.
And you were in, I don't even know what I would call it then, like...
Discovery phase.
The discovery phase, and then you went into hibernation, didn't speak to me for months and all that. And then
I think I tried.
Yeah? Well, we're both busy. And then talk to me about just the business side of things that has gone on in the past year, 18 months of getting this off the ground.
Sure. So I think the first kind of 6-9 months was very much just, when we spoke, is that they're kind of having coffees with people, doing it off the side of a desk, not really being full-time, just kind of hey, has this got legs? Is this ultimately, and I approach it like a VC, is this worth me spending the next 10 years of my life on? Is the prize big enough? Is this a business I want to build? Am I solving a real problem? Do the market care about this? And I think every conversation I had, I just got more and more excited and really I wanted to go for it. So I'd probably say from kind of beginning of 2024 was when we really started.
Right.
So like, so when I kind of was sure I wanted to go ahead with it, felt like I had a clear view of how to execute and had a map and a pathway of this is how the structure needs to look, and spent far too much time and money with lawyers. But all of that, we did an angel round in March last year. So we raised $1 million from a really good bunch of angel investors and some kind of VC scout funds. And then that enabled us to kind of build out all of the foundations. So we built the team. So the team's a real small but high quality team of really experienced people across Lombard lending and wealth management. And we've got an incredible board there as well. We built a really good first version of the platform. It'll evolve,
Yes.
it'll iterate, lots of developments we do in the future, but an incredibly robust end-to-end process that means we can do all of that monitoring, that underwriting, but make it look super slick to advisors and to clients. And we built out the kind of that legal structure idea further and formalized that. We got in place that debt facility that's given us that 160 million of firepower. So all of those foundations were being put in and signed the first kind of those first few wealth management platforms and partners that want to work with us. And we've been busy integrating into them. And so that's give us all of those foundations so that this, and we did our initial pilot loans and test loans last year. So from the start of this year was very much just getting out the blocks now. And we kind of, 2024 was building, 2025 is growing.
Yeah. So 2025 is what? Take this to market?
Yeah. So we've got also the wealth managers that we're working with are now kind of gone from their pilot and testing to being open for business. So this year is all about growing the loan book. Is like I said, we have a lot of dry powder to deploy. We're open for business. This year is about educating the market, making sure people are aware of what we do, when's right to use Lombard lending, when's it not. We don't want it used wrongly, but it's about growing, and we want to be at 100 million of loans by the end of the year, and that kind of growth of our loan book is the thing we're focused on now.
That's incredible. So the goal is 100 million by the end of the year. Talk to me about the fundraising process.
Sure.
How did you find that of pitching your idea? Obviously, you're an entrepreneur. You've built a business before. You've sold a business. You've exited a business before. So, but it takes a lot to persuade investors of your. How did you find?
And we're just about to close another raise, equity raise. So we're just about to raise now also as well. £2.5 million seed raise with a VC that's going to close in January.
So the 1 million was pre-seed.
Yeah.
This is seed.
That's it. Yeah. So, and I feel kind of fortunate that it was relatively painless in both times. And I think where we got lucky, and I do think it is a little bit of luck in it, is that I think in the angel round, I think there's a couple things. I think one, angels got it.
Yeah.
They got it. They were like, either they were individuals that now work with private banks and go, yeah, I love Lombard lending. I can't believe this isn't available to a broader audience.
Yeah.
Because a lot of what we do is actually making the minimums lower as well. No longer needing that £1 million for a private bank. We offer Lombard lending from as little, if a portfolio is 150K, we'll still lend against it. So a lot of the angels go, hey, great, I love this product. I don't get why it's not available to audience. So they really resonated. Or they fell into the bucket of, what? I've never heard of Lombard lending. This sounds incredible. Why have I not got it? And there's just a lot of will. They wanted to see it succeed because they want the product themselves. So I think we got really fortunate that we're in a space where a lot of the angels want to do it. But secondly, I owe a lot to a couple of very specific angels where they were just incredible insofar as I had a meeting with them and they wanted to invest, and then they introduced me to a friend who invested and a friend who invested, and it kind of spiraled. So there was a couple of investors that I owe a lot to for just making that angel round very, very painless.
Yeah.
That was super supportive and it was great. And I think people also just bought into the clarity of vision because I'd spent a lot of time thinking about this is exactly how I execute, this is where the space is, this is where the opportunity is. I think there's a lot of kind of clarity of vision that people got excited about. But I think the main thing is they just want to see it work for themselves.
Yeah, no, it's. I mean, I went through this journey with, and I love the, seed, pre-seed even investing stage. It's brutal, it's hard, but a lot of the entrepreneurs or angels that I spoke to will say something like the first SCIS, the first 150,000, so 150,000, it's like they get 50% tax relief on and all that stuff. So no brainer. And the investment is protected up to 75, 80%, whatever. So incredible. But you actually have a product that a lot of them can relate to.
That was it. And at the time, it was just an idea and a PowerPoint slide or a product, but they resonated with the idea. And then I think when it's come to this round, the great thing was I spent a lot of time early doors of making sure, speaking to investors 12, 18 months before I'd run a raise, going, hey, this is the plan. This is what we're going to be doing. That's how I think the market. I'm not asking for money today, but I want to keep in touch every 6 months. And when the investor that ended up leading the round had seen how quickly we'd executed over the course of last year, I think they saw the pace of execution, they saw the excitement from the market, and they were kept abreast of the journey. And I think just importantly, we're also transparent about the downs as well. Not just hey, here's a great news story. We were really upfront with them, this is what we're struggling, this is where the risks are. So I think by the time it came to putting together a round, we didn't even have a deck. The lead investor just said, right, now feels like the right time for us to take this to investment committee. Let's go do this. And we had a really, and they were the investor we wanted to go with all along the process. But it was just, I think we'd built a good relationship. They trusted the execution, and they trusted that we were doing business in the right way.
Great stuff. And the lead in this round is a VC?
It's a VC, yeah.
Right. Good stuff. Fantastic. Look, it's been really fascinating talking to you, learning about the journey that you've been on. For the purpose of our audience, the mostly financial advisors and people working within the financial advice profession, in and around the financial advice profession, they want to find out more about this. What should they do? Where can we find you? Where can we find more about Lombard lending?
So if you go on our website, firenzeme.com.
You have to spell that. Firenze.
Firenze. So I should a little bit anecdote here of where the name comes from.
Okay, please.
So Lombard lending originally, the original name for the business was very poor names like Lombardo.
Lombardo.
Terrible days was his working title. But the origins originally of Lombard lending comes from originally the Medici family based out of Florence.
Yeah, right.
They apparently did the first ever Lombard loan was to the Pope, secured against his gold bars. He wanted cheaper lending to finance his wars. So in the 14th, 15th century, the Medici family. So the origins of Lombard lending come from Florence. But then where it gets the name Lombard lending from is the Florentine bankers, all of the bankers from Genoa and Milan, all like this type of, hey, it's secured lending. Our risk is lower. If we lower the rates, more of our merchants want to borrow. So they became associated with this type of secure lending. And then those bankers from Lombardy spread across all of Europe and ended up in Frankfurt and Amsterdam and London. And they got known as Lombard bankers and Lombard loans when they brought this type of lending across it. And those bankers, that's where Lombard Street and the Bank of England is all named after these bankers that came across from northern Italy. But the origins all stretch back to the Medici family out of Florence. So so Firenze is the Italian for Florence, so it's kind of, it had that link, but also had a personal touch. My daughter's middle name is Florence as well. So and that did confer, so she didn't get named after the Medicis at all. But so it had that kind of natural personal touch, history touch. So the name just came and went for the Italian version because it sounded a bit more sexy and exciting. It's got a Z in it, so it sounds a bit more fintechy. So that's where the name came from. But Firenze is Firenze. So if you search Firenze Lombard lending, we'll very quickly come up. But also on LinkedIn is probably as good a place as any to reach out and find out a bit more.
Fantastic stuff. David Newman, the man who's studied the history of Lombard lending, named his daughter after Lombard lending, and indeed, bringing that into the world for more people to benefit from. Thank you for your time. Thank you for your wisdom. Thank you for coming on the show.
Thank you for having me.
That's a wrap on today's show. massive thanks to my production crew, especially Jake Osha, Melissa Canham, and the entire team. And of course, to our sponsor, Timeline, the market-leading provider of integrated planning technology and model portfolio service to advisors. I do hope you've enjoyed today's show. Head over to Apple Podcast and give us your review there. Until next time, goodbye.